Hello everyone. We were covering the accounting standard IFRS 15, which deals with the revenue from contract with customers. In this standard, we have a principle-based 5-step model for revenue recognition. And so far, we have covered step 1 and step 2 in greater detail, which involved identifying the contract with customer and identifying the performance obligations, that is goods and service in the contract. Today, we are starting with the step 3, that is to determine the transaction price in the contract. And after determining the transaction price, we will allocate the transaction price to each performance obligation in step 4 and then recognize it as a revenue in step 5. First of all, we will look at the definition of transaction price, and then we will discuss further modalities related to it. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods and services to the customer, excluding amounts collected on behalf of third parties, for example, sales tax. The transaction price is not necessarily the stated price or the stated consideration. The transaction price is the price or consideration that you expect to receive in exchange for providing goods and services to the customer under the terms of the contract. I will try to explain this with an example. Let's say we offer a financial reporting course with a fee of $200, and let's assume that 100 students enrolled for this course. Now, having 100 students enrolled for this course does not mean that our transaction price would be simply multiplying $200 by the number of 100 students and the transaction price is simply $20,000. In this case, we will consider our past experience, our historical data to see what percentage of fees we actually recovered from the students in the past, because when admissions or enrollments start, we encounter cases with discounts, concessions, scholarships, and some students may also lead to bad debts. So even if we enroll 100 students against the price of $200 each, it does not mean that our revenue, our transaction price would be simply $20,000. Instead, we will look at our past experience, our historical data to see how much amount we will effectively recover from the student, and that will form the transaction price of this contract. Let's consider another example. Suppose there is a hospital where the charges for an emergency bed are $2,000 per bed per day per patient. Now, let's say some emergency occurred, like a bridge is collapsed or some major accident happened, and the government made an announcement that it will bear the medical expenses for all the people injured in the emergency. Now, let's say in this scenario, 10 people are injured and brought to that particular hospital for medical treatment. That hospital won't simply calculate the transaction price or its revenue by multiplying the bed charges of $200 by 10 patients to get $20,000. Instead, the hospital will consider how much the government has historically reimbursed hospital in similar emergency situations before. The government may have received some concession or discount. For example, instead of reimbursing $2,000 per bed, the government may have reimbursed $1,200 or $1,400 per bed. In this situation, the hospital will not record a revenue of $20,000. Instead, they will assess how much they can ultimately recover from the government in such scenario, and that expected amount will form the transaction price of this contract. In the next part of this definition, it is stated that if we are recovering an amount from a customer on behalf of someone else, then that amount will not be part of our transaction price. The most common example of this is sales tax or indirect tax. sales tax or indirect tax works in a way that the supplier of a supply chain charges sales tax to the customer, and the amount they recover from their customer as sales tax is not the supplier's own income or supplier's own revenue, but rather it is an amount that they have to remit to the government of the country. For example, if I sold goods worth $100 and charged a sales tax of $5 on those $100 at the rate of 5%, then how much amount did I recover from the customer? It would be $105. So I would have a cash debit of $105. But is the entire amount of $105 mine? No. My portion out of this $105 is only $100. Therefore, the amount I will record as revenue, the amount I will record as income will be only $100. And the remaining $5 that I recover from the customer ultimately need to be paid to the government. So I will credit $5 to the sales tax payable to the government of the country. Debit $105 in cash, credit $100 to revenue, and credit the remaining $5 as sales tax payable to the government of the jurisdiction. Similarly, in a principal agency relationship, we don't record the entire amount as revenue that we recover from our customer. We will discuss the details of the principal agency relationship at some later stage. But for the time being, I am pointing out that in a principal agency relationship, you don't always record the full amount of revenue that you recover from your customer. For example, if I kidnap a child and told the parents that they have to give me $1 million, I would return the child safely, and they agreed. Instead of risking going myself for the delivery of child and the recovery of $1 million, I might find someone else to do it. Let's call this person the agent. I would give the agent the responsibility to deliver the child to the parent and collect $1 million from them. I would ask the agent to keep $50,000 for himself and remit the remaining $950,000 to me. Now, the question arises, is the $1 million recovered by the agent considered its income or revenue? The answer is no. The $1 million sent by the parent, out of which $950,000 are to be remitted to me and $50,000 are earned by the agent as a commission for its services. Therefore, the agent will only record its commission income at $50,000 here. But for example, if in my own company, in my own department, there is some sales staff and I tell them that they have to sell the financial reporting courses and I will give them a 10% commission. So for example, if the sales staff sells courses worth $20,000 and their commission is $2,000 out of that $20,000, then in this case, I will not record my revenue as $18,000, but rather the full $20,000. And the $2,000 that I will pay to my sales staff as commission will be recorded separately as a selling cost or a commission expense. So when do we record revenue on a net amount basis and when do we record it on a gross amount basis? We will cover this in detail later in the principal agency relationship. In the principal agency relationship, you will see that there are certain criteria, there are certain factors based on which the principal agency relationship is established. Where this relationship is established, the agent will record their share of income while the principal will record the entire amount of income. And where the principal agency relationship is not established, there will be an entity customer relationship and the revenue will be recorded on the gross amount basis with corresponding expenses recorded against the gross amount. However, we will cover this in detail later in the principal agency relationship. For the time being, we are looking at the definition of transaction price. In the definition of transaction price, we have identified two things. Number one is the expected consideration, which is what you expect to recover from the customer against the goods and services. And number 2 is the amount that you expect to receive on behalf of any third party. The most common example we have for this is sales tax. Now, there are 4 things that can impact the nature, timing, amount and the recoverability of this transaction price. And we will cover these 4 things separately in different lectures. When determining the transaction price, an entity must consider the terms of the contract, its customary business practices to determine the transaction price, the nature, timing and the amount of consideration promised by the customer affect the estimate of the transaction price. When determining the transaction price, an entity must consider effects of all of the following. Number 1, variable consideration. Number 2, significant financing component in the contract. Number 3, non-cash consideration. And number 4, consideration payable to the customer. So these 4 factors are the ones that need to be considered when determining the transaction price in your contract, because these 4 factors will somehow affect the amount, nature, extent, timing and the recoverability of your transaction price. And we will cover these 4 concepts or 4 areas in 4 separate lectures. For the time being, we have only covered the definition of transaction price, which is the expected consideration and does not include an amount collected on behalf of third parties or other parties. And these 4 factors will somehow impact the nature, timing, amount, extent and the recoverability of our transaction price. So in today's lecture, we started the discussion on the transaction price, and I hope I was able to explain these concepts to you effectively. We will conclude today's discussion here. Thank you.